Michael Landsberg is CIO at Landsberg Bennett Private Wealth Management, joins us with his take on the markets, the U.S. markets. Michael, lovely to have you. Thank you very much for joining us. Give us your own sense on these growth numbers, growth projections that the IMF has laid out, and whether you concur with the fact that underlying economic activity in the U.S. has actually not disappointed and may not warrant the kind of rate cuts that the market was pricing just 10 days ago.
Yeah, I would agree. I think the U.S. economy growth-wise is doing quite well. We look at a lot of the numbers, and the numbers have been pretty good. Earnings have come out only for about 20% of the S&P 500 at this point, but they've been solid. Earnings numbers. I think overall GDP growth is going to be solid. It's certainly not going to be India-like in terms of the growth, but it's certainly going to be solid enough for the economy to continue to do well. We're questioning whether you're going to see really any rate cuts in 2025. I think there's a myriad of things that are going to happen in the next 90 days that I think are going to put a lot of those on hold.
Yeah, but the comparison with India would be a bit misplaced given the fact that India is a $3.5 trillion economy and we're talking about the U.S. being a $26 trillion economy. But the larger issue that I want to touch upon is, of course, in terms of what the market takes away, because if in a higher interest rate environment the market has done so well, I wonder actually, I'm not sure, but I don't know how much of a tailwind would lower interest rates be at this point for the markets to edge higher. I mean, we're talking about 6,000 and beyond for the S&P 500 or a cap at 6,000?
Well, I think the rate argument is there's a lot of companies that do well with the lower rates, and certainly the companies that are growing. Right now, we think we're entering in the U.S. to slower growth environment, still growing, but inflation's starting to peak back up. I think we're going to see the cycle low was the September CPI number. I think you're going to start to see inflation tick back up, which that's really what you're seeing from the bond market. I think the bond market, the commodity market, and specifically precious metals and the dollar have kind of signaled that, hey, I think the inflation is going to come back. Certainly not to the 9% we saw a few years ago, but I think that's going to lead people to say, well, is the Fed really going to lower rates? I don't necessarily think we need to lower rates. I think the economy is doing well as it is, and I hate to use lowering rates in an environment where we don't really need to, because when we do need it, we're going to not have that ammunition to be able to lower rates to get things moving.
Michael, we're going to have you hold that thought. We're going to continue this discussion. Michael Landsberg of Landsberg Bennett Private Wealth Management is staying with us. We'll have plenty more with him ahead. Now, we're in the thick of U.S. earnings season, and as we mentioned, a chipmaker Texas Instruments rising after hours due after earnings came in at $1.47 per share on revenues of $4.15 billion. Analysts were expecting $1.38 per share on revenue of $4.12 billion, so a solid beat there. More pressure on Starbucks as the company battles slowing demand in the U.S. and internationally. Preliminary results showed a 7% fall in quarterly same-store sales, the sharpest drop since the end of the pandemic. New CEO Brian Niccol said the company would address the falling sales in its earnings call on October the 30th. General Motors shares flying in the regular session after investors liked the raising of its full-year forecast for the third time this year. And we'll talk more about GM later this hour. And it's a busy news week for McDonald's. Fresh after staging a photo op for Donald Trump's campaign earlier this week, shares falling after hours due to reports of an E. coli outbreak linked to the fast food chain's Quarter Pounder burger. The CDC said 49 cases of E. coli across 10 states were linked to eating McDonald's. One person has died so far. McDonald's shares falling after the bell. And we're back with Michael Landsberg, CIO at Landsberg Bennett Private Wealth Management. And if we can continue our discussion here with the earnings that have come through. General Motors was a big standout and investors really liked it. What stood out for you in the earnings parade?
I mean, the banks have been really good so far, and that's really kind of sets the table for the U.S. market. It's so consumer driven, so we're seeing that activity is good on the credit card side, the spending. So much of the U.S. economy, I think 70% of it's consumer driven. So we're excited to see some of that and some of the good numbers there. We haven't been really positive on restaurants for a while, so the Starbucks news is not really a surprise. I think McDonald's will report actually an outlier. It will report good earnings when it does report. But obviously, this news tonight with E. coli, with the slivered onions, is not going to bode well for the stock for the next 30, 60 days until they get an idea of where this is. So I think overall we've been excited about earnings. We think actually NASDAQ earnings will be much stronger. It'll be double digits again. We think S&P will be high single digits in terms of earnings growth year over year.
Now, just lending from the IMF World Economic Report, they were saying that the United States growth will be supported by that of consumption, consumer-related. In that aspect, would the consumption stocks be one of your picks? What sectors are you liking?
Well, the issue I think we've got is there's some areas of the market we certainly think are going to continue to do well. Areas, for example, in this higher rate environment, we look for companies that are growing. So we still favor tech. But some of the names that we like in particular, and they'll have a little bit of a play that are kind of not tech. Hermes is a name that we like. Big French purveyor of luxury goods. About 47% of their business is actually Asian business. And we think that's a good market because what we're seeing now is whether it's the Chinese market, the Japanese market kind of coming back from some doldrums, and we think that's an opportunity to continue to grow. It's one of the only big luxury brands that are the French ones of the three that we like. The other two, Louis Vuitton, we're more neutral on, and Kering is one that we think you probably could short for that matter. But Hermes has done a very good job. It's very aspirational. We think that's a great story. In the U.S., we also like Invitation Homes, which is one of the largest providers of rental homes in the United States. And real estate has been expensive in the United States. Interest rates have been very high. They're slow to come down. And these real estate companies, for example, that are in the rental business, it's a very strong market. They do have exposure in the southern United States, which with hurricanes, the irony is when you lose inventory, prices and rents go up. So we think actually in an odd way that the hurricanes will probably help them. And lastly, we do like an online auction company called Copart. We're one of the largest auction for online vehicles. There's really two, but they're one of the largest with the two of them have about 80% market share. They've got double-digit growth for the last 10 years in terms of earnings, and it's a 45% margin business. So we like some of those names that are not necessarily in the tech world. We still obviously like tech, and the areas that are going to grow in AI we think are going to continue to do well. And some of the semiconductor equipment companies, as you saw with ASML, not.
Got it, Michael. I know you also have a preference for the Indian markets. Completely out of time, but thanks very much for joining us with your take on the markets and your insights as well, and your stock ideas too. Have a great evening.